Okay, good evening, everyone. Welcome to our live session for SBR. Can you please confirm you can hear me before we start? Why should please confirm on the chat room so we can start? Okay, thank you, sir. Thank you very much. So we're going to start from where we stopped. I can recollect. I think we have started IFRS5. Okay, thank you, ma'am. Thank you. Okay, we started IFRS5, asset held for sale, and of course, discontinued operations. So fully, we're able to complete IFRS5 today. Then I'll take a breather in 10 minutes to explain IAS10. And then we'll go straight to IAS21. That's very important. Okay. So the last time we checked IAS36, impairment of assets, when we said an asset is impaired when the carrying amount exceed its recoverable amount. So basically, the recoverable amount of an asset is higher fair value, less cost to sell, and of course, value in use. Okay. Right. And I think I was also able to establish some accounting issues around IAS36, how it can be used, or how it can lead to earnings management. Okay, we also take a look at cash generating unit, if you remember. We said 3 procedures has to be followed. Obviously, impaired assets, reduce goodwill to 0, and of course, allocate impairment loss balance of the assets on pro rata basis. Then we take a look at IFRS5. I think I took my time to explain the conditions that has to be met, before you can classify an asset as held for sale. We said there are 2 of them. The asset must be available for immediate sale in its present condition, and the sale must be highly probable. Okay, but don't forget that why am I classifying asset as held for sale? Is basically, the kind amount of that asset recovered to sale rather than continuing use. Okay, and for the sale to be highly probable, the proper level of management must be committed to a plan to sell the asset, an active program to locate a buyer and complete the plan must have been initiated. The price offered for the asset must be reasonably in line with its fair value. And of course, the sale is expected to occur within the next 1 year, and there's no plan to withdraw the asset from being sold. So if you remember, I was able to establish why and how, IFRS5 will be used as earnings management as well. I said 3 things will happen. That will be represented separately on the face of the financial position. It must be subject to annual impairment tests, and the asset held for sale are no longer depreciated. So we spent a lot of time. I think we looked at this exercise, and we looked at exercise 3 as well. And then that's where we stopped. Then I needed to now explain measurements. Okay, so the conditions has been met. How do I measure? I think I told you measurement talks about value. Okay, now assets held for sale are measured at the lower of their carrying amount and fair value less cost to sell. Now don't mix it up with recoverable amount of an asset. The recoverable amount is the higher of fair value less cost to sell and value in use. So there's no value in use here. So when an asset has met those conditions, or a disposal group has met those conditions, so for me to bring it out and class it as asset held for sale, I need to remeasure it. So how do I remeasure? I have to look at the carrying amount. I also look at the fair value less cost to sell. So the lower of the two will be the new amount for that asset on the face of the financial position. So let's assume that the carrying amount, which I believe everybody can compute, is 600,000. For example, the carrying amount of this asset is 600,000. When I look at fair value less cost to sell, it is 850,000. Which one is the lower? Obviously, the carrying amount is low. I continue to carry it at the carrying amount. You will not revalue. I'm not revaluing here. I just wanted to see how much am I going to use to carry the asset that's just been held for sale. Okay. On the other hand, if the carrying amount is 600,000, okay, the kind amount is 600,000. So when I look at the fair value less cost to sell, it's giving me, let's say, 350,000. Okay, that means it's lower by 250. Did you see the point? So, and I'm taking the lower. I will now have to write down the asset from its kind amount of 600. I write it down to 350. The difference between the two, that is 250, is taken as impairment loss. Okay, so that's what you have here. Where fair value, less cost to sell, is lower than their carrying amount, the item is written down and the write down is treated as impairment loss. It's as simple as that. Okay, so all these accounting issues, I've tried to explain them the last time. So let's take a look at exercise 4 to demonstrate our understanding. Look at the requirement. I have taken your accounting issue already. I just want to further, go much deeper into IFRS5 so that you understand more. So you are taking SBR. I've tried to tell you what the examiner might be picking you up from, and you are taking ICANN. Okay, most likely you do all of this. Okay, now at what value? Did you see the machine be stated in Mitchell Cole's statement of financial position measurement? Okay, so sometimes you could say, what will be the accounting treatment? So you need to be familiar with that. Now, when I see this requirement, this is not telling me that this is IFRS 5. So how will I know? So let's go straight to the question. Because I'm reading the question, I'm breaking it down so that you see how to break down question. On 1st January 20x1, I have told you that date is very important when you are dealing with financial accounting questions. Mitchell Cole bought a chicken processing machine for $20,000. It has an expected useful life of 10 years and a near residual value. That statement has not told me that this is IFRS 5. Okay, it looks like what's it called, PPE, I-16. Okay, but I don't know yet. Then I go to the second paragraph. On 30th September 20x3, I have told you date is very important. Mitchell could decide to sell. So when I see the word sell, there's only one standard that's talking about selling here. It is IFRS 5. And start actions to locate a buyer. Can you see the conditions? They were telling me that those conditions has been met. That's what they are telling me. So I don't bother about that. So I assume the conditions has been met because it's asking me for the value. Okay, the machine and ensure supply. So Mitchell Co is confident that the machine will be sold fairly quickly. Its market value at 30th September 2023 is 13,500, and it will cost 500,000 to dismantle. Okay, to cost $500 to dismantle the machine and make it available to the purchaser. The machine has not been sold by the year end. Okay, you decide to sell, makes it IFRS 5. I remember in my age, now I will always say that you can't use your brain to solve any accounting questions. You have to go back to the standard. So I remember that in my measurement criteria, when it comes to IFRS 5, the standard says it has to be measured at the lower of their carrying amount and fair value less cost to sell. I needed two things, carrying amount and fair value less cost to sell. It's as simple as that. Then I asked a question, where is my carrying amount? The question did not give me, unlike the questions been solving. So it wanted me to compute, and I've told you how to go about your carrying amount. You simply look at the cost of the asset. If you have residual value, you remove it. You divide by the number of years so that you can have your depreciable amount. Then you accumulate it and remove it from the cost. Then you have your carrying amount. It's as simple as that. Then I ask this question, where is the cost of this asset? It will tell you. He said he bought it for $20,000. I pick it out. $20,000, fine. Do I have any residual value? It said with a new residual value. Can you see? By the time you ask the right questions, those questions will supply you your answers. So I have 0. Then what is my number of years? It will pick it up. It will tell you. Okay? It will tell you. So I'll now say 20,000 divided by 10. I have 2,000. That 2,000 is my depreciable amount. I have to depreciate 2,000 every year. Then I ask, when did you intend to sell the assets? It said on that second paragraph, on 30th September 20x3. This is how to break down questions. 30th September, they decide to sell. Remember, once an asset has been classified as held for sale, depreciation will stop. Remember, I said it the last time. I emphasized, I even told you why companies will want to classify asset as held for sale in order to boost their reported profits. Okay, so depreciation stop. So that means when I buy this asset, 1st January 20x1, can you see? 1st January 20x1, in December 20x1, I will depreciate by 2,000. Do you remember? December 20x2, I will also depreciate. When I come to 20x3, I will not get to December because the criteria were met at what's it called, 30th September 20x3. So in that case, I will have to prorate. So I'll now say 9/12 because January to September is 9 months. If you are not sure that January to September is 9 months, I'm begging you, use your fingers in the exam of January, February, March, April, May, June, July, August, September. So that's 9 months. I'm pretty serious. If you use 10, everything will be wrong. If you use 7, everything will be wrong. If the examiner has said 1st October 20x3, it's still 9 months. It's okay, except it says 38th or 31st October. That makes it 10 months. So you have to be very careful. Okay, if you have said 1st September, that is 8 months. Okay, so you need to be careful. Okay, so I have 9/12 multiplied by 2,000. That is 1,500. So 2,000 year 1, 2,000 year 2, 1,500 year 3. I add it together. That gives me that 5,500. Okay, that's 5,500. Then I remove it from the cost of the asset, which is how much here? 20,000. Okay, $20,000, so that I can have 14,500. That is my carrying amount. I move to the next stage, fair value less cost to sell. The examiner has given me, instead 13,500 is my fair value, and cost to sell or cost to dismantle is 500. So when I net it off, I have 13,000. Okay, so which one is the lower? Because I have to measure at the lower. Obviously, 13,000 is the lower. Okay, so I will now write down that asset from 14,500 to 13,000. The difference between the two, I'm writing in at 1,500. I take it as impairment loss, and that's the end of that question. It's as simple as that. So this is what I was saying earlier. Can you see? So you bring on your course. It's because I'm teaching. That's why I'm doing all this breakdown. In your exam, you just sum it up, you move straight. Nobody marks all this breakdown I'm doing here. Okay, so you do that, you do that, you do that, so that I can have your 14,500. So you now come here. This is your fair value less cost to sell. Okay, so that 1,500, can you see it here? You take it as impairment loss, right? You take it as impairment loss, as simple as that. So that's that. So you have exercise 5B there. You can take a look at it. It's the same principle. It's the same principle. So you have the solution there. You can, at your leisure, you can, take a look at what you have there. Okay. Right. So now the other aspects of IFRS5. So let's do that in the next 15 minutes thereabouts. So we can close the standard. I can move on. Okay. The other aspect of IFRS5 is discontinued operation. If you look at that standard, said asset held for sale and discontinue the operations. Okay. Now, let me try to explain the discontinued operations. Let me just use, let's say you have a company, your company, okay, you have so many components. For example, you could be dealing with estate management, okay. You also have transport business. Then you also have, let's say, consulting, all right. You also do maybe bookkeeping or whatever. Okay, consult. So you have about 3 or 4, 5 components of your businesses. Okay, so that's an operations. So it could be by component. It could also be by geographical, area of operation. For example, maybe you've seen this all these mobile companies, they will say Nokia West Africa, Nokia South Africa, and all of that. So they could also separate their business by way of geography or geographical, areas of operation. So those are components of operation. So I can decide to discontinue a particular operation, probably because of terrorism, or probably because they are generating losses. Okay, so there could be several reasons, why I want to sell off or dispose a particular operations. So a discontinued operation, according to IFRS5, is a component of an entity that has either been disposed of. Now, listen to that. It has either been disposed of. That means during the year, I have sold it. So that means when I'm preparing my account at the end of the year, when I'm preparing my account at the end of the year, I'll take it as discontinued operation because I have sold it during the year. That has either been disposed of or is classified as held for sale. So that means at the end of the year, I have not sold it, but I wanted to sell it. So in my account, I will classify it as held for sale. So in this case, I'll call it discontinued operations, or operations held for sale. Now it also represents a separate major line of business or geographical area of operation, or is a part of a single continued plan to dispose of a separate line of business, major line of business or geographical area of operation. It could also be a subsidiary acquired exclusively to resell. So that's discontinued operation. At this level, the examiner in ACCA will never ask you, even like ICANN, what is a discontinued operation? They won't ask you. However, they can create a scenario that will warrant you, when you want to start your response or your answers, to define this. So you can't say straight up, what is a discontinued? No, you won't. But indirectly, they can ask you. So what I'm saying in essence is you have to put this in your head. It's as simple as that. You have to put it in your head. In fact, I think I'm also planning, a question around here for your mock. So that I prepare you to see the kind of questions you're going to see, especially in ACCA. That mock will be sufficient. I can bet it with you. Now, so that's what you have as a discontinued operation. So don't forget, it's a component of an entity. That's key. That has either been disposed of or is classified as held for sale. So what's the recognition criteria? Because I can't just wake up and say, this operation, I want to sell it off. So conditions must be met. Interestingly, it's the same conditions that we have learned. Remember those 7 conditions? The asset must be available for immediate sale in its present condition. The sale must be highly probable. An appropriate level of management must be committed to the plan to sell the asset. An active program to locate the buyer must have been initiated. The price offer for the asset must be in line with fair value. The sale is expected to occur within the next 12 months. And there's no plan to withdraw the asset from this one. It's the same. So the only thing is you just replace assets with operations. So instead of saying the asset must be available for immediate sale, say the operation must be available for immediate sale in its present condition, and the sale must be highly probable. For this to be the case, an appropriate level of management must be committed to a plan to discontinue the operation. So that's what you just said. So that those are the recognition criteria. So it's very simple. Just that what you've learned earlier, you just interchange it. That's it. Now, let's now look at measurements. Remember, measurement of assets held for sale. They are measured at the lower of their kind amount and fair value, less cost to sell. So when it comes to discontinued operations, think about 2 things. Now, what the standard is saying is that the post-tax profit or loss of the discontinued operation. So you have to look at the total or the sum of the post-tax profit or loss of the discontinued operation. Post-tax, that's after tax. So what is the loss of that discontinued operation? And the post-tax gain or loss, they are different. First is saying post-tax profit or loss of the discontinued operation. The second is saying post-tax gain or loss recognized on the measurement of fair value less cost to sell should be presented as a single amount on the statement of financial position. So that means what that discontinued operation, you're going to measure it at fair value less cost to sell. So it could either give you a gain or a loss. How will I have a gain? That means the market value is higher than the kind amount. I have a loss if the kind amount is higher than the market value. Okay, so that's it said post-tax gain or loss recognized on the measurement of fair value less cost should be presented as a single amount on the face of the profit or loss. So I'm going to use a question to demonstrate what you have here. Okay, so we're going to use a question. This is what I was explaining, right? Okay, so we're going to use a question to demonstrate this. Is that okay? So, but you need to understand, put that in your head. So let's look at this question. Then I go to question 7, and that will be the end of IFRS5. So I can quickly explain IAS10. So I'll be glad if we can finish off IAS21 this night. Okay, so that next week is starting off with group accounting. Okay. Let's see this question. Let me look at the requirements so that I'll just be answering it as we are reading. Explain whether each of these subsidiaries meets the definition of a discontinued operation as defined by IFRS5. Okay. Portugal Group of Companies has a financial year end of 30th June 20x4. Sorry, am I playing? I'm not playing actually. I'm just trying to make the class interesting, and I needed to, I needed to be in the lecture so that I can really say everything I wanted to say. Okay, so that's why I'm trying to gesticulate. That date is very important. If you miss out that date, you can't solve this question. Okay, that's the year end, so they don't write it there for fun. All right, so 30th June. That means the beginning of this accounting year would have been 1st July, 20x3. I think I'm correct, right? Okay. Right. So now the financial statements were authorized 3 months later. The group is disposing of many of its subsidiaries, each of which is a separate major line of business or a geographical area of operations. A subsidiary England was sold on 1st January 20x4, and the requirement says I should determine whether this subsidiary meets the definition of a discontinued operation. How will I know? My accounting year is 30th June 20x4, 1st January 20x4. 6 months down the line, I sold subsidiary England. Is it a discontinued operation? I don't need to tell me that that is a discontinued operation. Do you know why? We said a discontinued operation is a component of an entity that has either been disposed of. Did you see that? It has been sold. So it's a discontinued operation. Okay, if I've not sell it and I'm at the year end, I check whether those criteria has been met. That is when I classify it as held for sale. Does that make sense, right? All right. So it meets the definition. Then part B or bullet 2 of that question. On 1st January 20x4. Sorry, let me try and pick that. Okay. An announcement was made that there were advanced negotiations to sell subsidiary Switzerland, okay, and that subject to regulatory approval, this was expected to be completed by 31st October 20x4. Okay, can I classify it as held for sale as at year end? Okay, so let me try to analyze that. He said an announcement was made during the year, okay, that there were advanced negotiation. What does that mean? They have found a buyer, okay? They have negotiated the price. It's just for the buyer to pay, just pay, okay? But they were waiting for regulatory approval, and this was expected to be completed by this date, okay? So that means there's no barrier. The asset, the operation or whatever is available for immediate sale. The price has been agreed and is expected to occur within the next 12 months. This is within the next 12 months. Can I classify it as set for sale? The answer is yes. Okay, so that's how to analyze that. Then 3, the board has also decided to sell subsidiary called France. Agents have been appointed to find a suitable buyer, but none have yet emerged. The agent advice is that potential buyers are deterred by the expected price that Portugal hoped to achieve. Most likely, the price offered for this operation is not reasonable in line with its fair value. That means you cannot classify it as held for sale because, even the agent is even saying people are running away because of the price. Okay, so that means it's quite higher than its fair value. Okay, so you can't classify it as held for sale, so it doesn't meet the definition. Now, the last one here, he said on 10th July 20x4, an announcement was made that another subsidiary, Croatia, was for sale. It was sold on 10th September 2014. It was sold on 10th September 2014. This, can we say this met the definition of a discontinued operation as per IFRS5? What is the answer? Let me tell you the answer. It's very straightforward. The answer is no. The answer is no. Do you know why? Now, I said earlier that date is very important. This was after the year end. Can you see that? 10th July was after the year end. So this is not within the reach of IFRS5. It's within the reach of another standard. That is IAS10, events after the reporting period. So this announcement can be a non-adjusting event that will only require a disclosure in the notes to the account. And when you are making that disclosure, you talk about the nature of the event and the estimate of the financial effect. And obviously, I extend and the next thing I'm going to explain. Okay, so that's it. That's the end. That's the end of that question. Any concern for me? If you don't have concern, so let's go to the measurement. So I'm going to use this question to demonstrate the measurement. In case you have questions, so please feel free to put it up on the chat room. So I'll stop by to attend to your question. Now look at part A of this question. I won't waste time reading that, but let me just go to requirements. It says discuss the condition which must be met for a non-current asset to be classified. So everybody should be able to handle that. Okay. So let's look at part B of the question. Even if you cannot handle it, the solution is there. But you should be able to handle because I've really explained. Okay. Now, Bangoshe PLC is a long-established travel agent operating throughout a network of retail outlets and online stores. In recent years, the business has seen its revenue from the online store grow strongly and that of the retail outlet decline significantly. On 1st July 2017, the board decided to close the retail network at the financial year end as at December, whatever. Sorry. Now, the directors are seeking advice regarding the treatment or the. I'm trying to understand the question actually. Treatment, when I say question, just understand, then you apply the standard. It's as simple as that, okay? Now, in the statement of financial position, as well as treatment in training result, okay. So the following figures are available, okay? So we're giving carrying amount, all right? That's fine. Fair value, okay? Other expected cost of disclosure, okay, that's fine. All right, so, okay, so now I think the issue was they wanted to close down, let's see. Okay, they want to close down. Can you see? They want to close the retail network. So you need to understand that. That's what I wanted to try to understand. Okay, so they want to close it down as at this date. So this is very key. Okay, as at this date. So they want to close it down because the sales is declining. So we're now giving this figure. So you could see the online figure and the retail outlet for last year, 2016. You could also see the figure for this year. So this is probably the reason, can you see, why they want to close it down? So they were actually making losses. Okay, you see the losses there. All right, so that's brilliant. So that's how to pick up questions, then you know what to do. All right, so I have seen that information. I think I have a fair idea of what they are saying. So let's look at the requirement. Said outline the condition which must be met. You should be able to deal with that. Okay, so now part 2 said draft the statement of profit or loss for Bangoshe for the year ended 31st December 2007 together with comparative figures. Okay, so what do I need to do? I pick up this trading results. So I'll just start. I'll say revenue. Remember, I will only do 2017 and 2016. Is that okay? Because it said I should show comparative figure. But when doing it, I don't need to say online or retail. Remember, we are scrapping retail in the current year. So that means I will only show the total figure or the cumulative figure for both online and retail for last year. So when I say revenue, I will have to add 48 plus 18. Okay, let me show you that. I think I have it. Okay, can you see? So if you had it, you have 66. Okay, but for the current year, you only pick 58.5 because I'm discontinuing our operations. So I will not report it as a continuing operation. I will only show the post-tax profit or loss. Can you see? The total sum of the post-tax profit or loss of the discontinued operation. 2, the post-tax gain or loss. Okay? Recognized as a result of the measurement of fair value less cost of sales should be shown as a single amount in the statement of what's it called? In the statement of profit or loss account. That's what I'm showing. Okay, so I do the same thing for cost of sales. I add these two together. I pick only 19.5. Okay, so that's what you have here. Can you see? So when you add that together, you have 30. So you now have 39 as a gross profit. Then for your operating costs. So when I come to operating costs here, you also pick these two. So when I come here, I have 15 here. Okay. Now here they also said other expected cost of closure. Okay. Other expected cost of closure. So you have to add this 5.85 to this 15. Let me see whether that's what I did. Okay. Can you see that? That's it. Working 2. Okay. This 15 and 5.85. So that's how you have this 20.85 here. Can you see that? So that's working 2. All right. So for last year, you just add up. All right. Now I have my profit for the year from continuing operation. You agree with me that this is continuing operation, and that retail outlet was continuing operation as a last year. That's why we are adding it. But for this year, I'm only showing the online. Okay. Now I will now show the loss as a result of fair value less cost to sell. Let me show you again so that you remember what I was talking about. Can you see? The post-tax gain or loss recognized on the measurement of fair value less cost to sell. So I now come to fair value less cost to sell. Can you see? Carrying amount is 30 million. Fair value less cost to sell is 25.8. Can you see? That's a loss. So now remember that. So when I pick up that loss, remember that I made this loss last year. This year, 2017, I have to also show it. So I will now add this 4.5 with a loss that I've made here. So I think there should be a workings for that. Can you see? This is a 1.5, the post-tax loss of the discontinued operation. Did you see? So the second one is now the post-tax impairment loss recognized on the measurement of the building. So that's that 30 minus 20. So I have 4.2, I have 8.7. So that's what you are bringing up here. And that's the end of the question. It's so simple. But if you don't know it, you don't know it. As simple as that. That's the end of IFRS5. Any question for me? If I explain IAS10 in 10 to 15 minutes, then I go straight to IAS21. The effect of foreign exchange rates. Effect of changes in foreign exchange rates. Okay? A question for me? So that means we are understanding. Okay. Okay. Oh my God. That I'm fast. Oh, you're the one that is slow. Sorry. I'm not actually fast. Even if I was fast, I was repeating so many things at the same time. Okay, I was fast, right? Oh, really? Oh, sorry. Okay, let me look at these comments. Is it possible to devise a means of writing this solution solving? To devise a means. Is it when teaching or when you're writing? Let me understand that. Okay, is it possible to have, okay, when teaching, to have a board? Oh, that would be, what's it called? There's a technology for that, but it's very expensive, right? Yeah, there's a technology for that. I think I bought one board, marker, but I'm not sure whether it will work with Zoom. Yeah. So that when I write, you see it on the screen. Maybe what I will do over the weekend, I'm going to test run it, but I won't promise actually. So I just try, but it's very expensive actually. So I'll try that, just like the way what LSBF normally use. Okay. So but I'll try to test run it. Now, okay, the scrolling up and down is confusing. Yeah, I understand. I understand that. That's why you have the material with you. Okay. So that's why you have the material ahead of the class. So what I would advise is print out the materials. Okay. So even if I scroll up and down, you have the material ready. Okay. So it will help you, whatever page I have, you have, since you have the material. So to help you. But what is important is for you to get the explanation. So that LSBF is quite expensive. Very expensive. But I think I got one board, what they call drawing board. Yeah, but I'm not sure whether it's going to work with Zoom. So, but I will practicalize it over the weekend. I have the time. So let me see whether. But don't also forget that if I want to start working, it won't be everything. It will just be some key areas. If it will work actually, so that we really manage our time. Okay, so that we can cover. So I quite understand, but notwithstanding, just go over. Okay, maybe another option is what came to my mind here is what I will just do. Maybe from next whatever is I will have now can you see what I was trying to do? So I will have the solution on another tab, then the question on another tab. Okay. So that I will not be scrolling up and down. I think that should also work out. Okay. So I'll just create, a question on this platform. I'm sure you can see that, right? Okay, then I have the solution somewhere else, so that I'll have them side by side. Okay, so that will also work. Okay, yeah, yes, sure, yeah, just little illustration. Yeah, you're correct. So that's don't worry, we'll improve on that in the next class. So I'll just do, if the board works fine, we'll do that. Just like all these complex solutions, I'll work it on the board, all right? But if it doesn't work, I think this will work, okay? This will work. So I have a question on one tab, I have the solution on the other tab. So instead of scrolling up and down, so I'll just be doing like this. So I think this will work, okay? Then also do something for me. Just try to print it out, okay? Print the material out. So for material for next week, we'll make it ready maybe latest on Monday. We'll be having a class on Tuesday, yeah, so that you can print it and have it handy before the class, okay? So thank you for your understanding. But this question that we just solved, okay, look at it again, listen to the video again. So if you have issues, let me know. It's quite straightforward actually. Okay, let me just do this. For the discontinuing operation, is this measurement. Most lecturers, they don't take this. They will stop at this, okay? They will stop at, what's it called? The recognition. They will not tell you the accounting treatment, okay? They won't tell you, but it's part of your syllabus. Now, you are doing just two things. You will look at post-tax profit or loss of the discontinued operation. So in this particular question, sorry for the scrolling, I know it's a problem, right? This is the loss. That's what they're talking about. Is that okay? And that is what we brought here. Can you see? Post-tax loss. It will be in the question. Okay, it will be there. So just pick it out. That's what that is saying. So sorry for the scrolling. Sorry. I just want to re-explain again. So that when you pick it up, You will understand. Now, the second one, he said, post-tax gain or loss recognized on the measurement of fair value less cost to sell. You are not hearing this for the first time, Abby. Yeah, you're not hearing this for the first time. So in the question, you now come and look at the carrying amount. Can you see 30 million? Fair value less cost to sell 25.8. So carrying amount is higher. That's a loss. If I needed to sell, I can realize 25, but I have it in my book as 30. So the difference between the two is what we call the post-tax gain or loss. But in this case, it's a loss. Okay, so you now bring it up here. So that's what we have here. Post-tax impairment loss recognized on measurement. So that 30 minus 25.8. So you have this 4.2, which is, if you add it together, you have 8.7. And that's what we bring in. Loss for the year from discontinued operations. Did you see that? So what we have from revenue, cost of sales, my profit, operating costs relates to the online alone. Is that okay? Because I have discontinued that retail outlet. But for last year, retail outlet was still working. So it's a continuing operation. That's why we added those figures together for last year. Okay. So up to this place, it is for the online. Okay. Up to here. So it is only the post-tax profit or loss of the discontinued operation, which is that 4.5, and the impairment recognized as a result of fair value less cost that we added up. That the standard is saying it has, because it's that loss from that discontinued operation must reduce your profit for the year, your performance for the year. That's it. So that's what we've done. Okay, so I believe that should be a little bit clearer. But if it's not still clear, just call me. Okay, or so send a chat to me. But the first thing I will just tell you is, I'm not sure if you understand Yoruba here or Yela. So you understand. But don't worry, we'll improve on scrolling in, scrolling up and down. It actually occurred to me, yeah, in the afternoon. Okay, it actually occurred, but it was very late, so I could have, prepared 2 copies of this material so that I can do what I said. That actually occurred to me. But obviously from next week, we'll do that. Thank you for your understanding. So you have some questions there that you can practice. So let me quickly explain. Sorry, what time are we supposed to stop? 10:30, right? Oh, okay, fine, brilliant. I thought it's 10. Yeah, I was afraid. Oh yeah, like in Jesus' name. That's funny, right? Yes, so oh yeah, but you must understand, okay? You understand. You see, I have to be a little bit fast, okay, but not too fast actually. But when I get to levels where I know it's complicated, I will slow down. Obviously, I'm going to slow down, okay? I'm going to slow down because I can't be too slow and I can't be too fast. And I promise you that we are going to touch every aspect of the syllabus, okay? We are going to touch, because the way ACCA exam is structured, your SBR, they will touch more than 70 to 80% of the syllabus. They have a way of scattering those questions. They will make sure they touch almost everywhere. Okay, so it's better we touch everything so that at least you have an idea. And I've also told you that make sure you attempt all the aspects of the question. Just say something, even if you're not sure. Just say something. That's what the examining team, that's what they normally say. Okay. All right. Now, I'll just explain this. Okay. Most likely, this will be lumped in a scenario question with another standard, but you need to understand what IAS10 is all about. I think I've been taking it every diet in ICANN, and ICANN did not test it at CR level, was regular at FR level. But I was shocked last diet, it was tested. Okay, so it shows the importance of the standard. So in SBR, in SCC, just a flashlight just come out and but you should be able to understand. So let's find out. I will come down to the lowest level to explain. Then I take it up to a more technical level. Now, event after the reporting period. So let's see whether I can do this by 10 I should stop so that I can do IAS21. Okay, event after the reporting period. Now, so let me give an illustration. So let me choose January to December, sorry, as my accounting year. All right, sorry. Okay, sorry. Now, that's my accounting year, all right, or they also call it financial year. But in ACCA, they normally use October or April to the next year. Okay, but let me just use January, at least for you to understand first. January to December, that's my accounting year. So I prepare my account. So let me use 2020, January 2021, right? Okay, so I use 2020. So I prepare my account for that year, all right? So after the year end, but before financial statements are authorized for issue. So that's something we also call authorization dates. That's the date financial statements are authorized for issue. Usually 3 months after the year end. Okay, remember the year end is December. All right, so that means by March 2021, financial statements should have been authorized for issue. Okay, for appeals, right? Okay, now that's authorized. So there's always authorization date, except in your exams. You know, the examiner gives you a specific day. It can give you June, it can give you May, it can give you April. Just follow suit. But I think in practice, it's usually 3 months after the year end. Okay. Now, so you understand that, right? So you already know financial year, January to December. You read that, and the balance sheet date is December 31. It's different from the last date of transaction. We are not bothered about last date of transaction here. It's only when you are doing your external auditing you can bother about that. Okay. So, but we are bothered about balance sheet date. That's December 31. So between December 31 and let's say March 31, you know, that the financial statements are authorized for issue, a lot of things would have happened that will affect that financial statement. And that's what we call events after the reporting period. Okay, so I am out of the reporting period, but I have not authorized the financial statement for issue. Then a lot of things happened between January, February, and of course, March. That's what they call events after the reporting period. So there are those events, both favorable and unfavorable, that occur between the end of the reporting date, but before financial statements are authorized for issue. Does that make sense, right? So those events that occur, it could be favorable or unfavorable, that occur between the end of the reporting period, for example, December 31, but before financial statements are authorized for issue. For example, March 31, 2021, okay, that occur between those periods, okay? That's what is called events after the reporting period, okay? So I think you understand that, right? Okay, now we now have two types of events, just two of them. We have adjusting events and non-adjusting events. Adjusting event and non-adjusting event. You see the way I'm teaching, right? I might be a little bit fast, but if you notice, I'm repeating those words, you know, often and often, so that you can understand what I'm saying. Okay, so we have adjusting and non-adjusting. Those are the two. Now, for exams, let's expect the examiners are asking you what are the two types of events at this level. It frames a scenario, okay, and ask you to respond. So how will you know that it should be an adjusting event or it should not be? It should be a non-adjusting event. So from the word adjusting, okay, it simply means those events will require that we make adjustment to the figures in the financial statement, even though we are in February 2021. But certain events has occurred that is affecting 2020's account. So adjusting events are those events. Listen, adjusting events are those events that provide further evidence of condition. Listen, that provides further evidence of conditions that existed at the balance sheet date. Okay, they provide further evidence of condition that already existed at the balance sheet date. What does that mean? So let's say, for example, when I'm recording my receivables as at the year end, I recorded 100 million. Okay, I recorded 100 million. That means company A, B, C, D put together, they are owing me 100 million. So this one is owing 30 million, the other one 20 million, the other one 25, the other one 25. So everything put together 100 million, right? So that's what happened as at the year end. So I have receivable 100 million. In January or February 2021, I was told that company A that was owing me 30 million was declared bankruptcy as of December. And I'm getting to know in January. Okay, so that already provides further evidence of conditions that existed at the balance sheet date. That bankruptcy happened at the balance sheet date. So what happened? I will go back to that losses account and write that 30 million off. Okay, except they tell me that out of the 30 million, I can only recover 10 million. That's when I just write off 20 million. Is that okay? Okay, so that's why adjusting event will require that the figures in the financial statement are adjusted for. Be with me here. Let me give you one trick that most lecturer may not give you. Let me give you one trick. If the bankruptcy happened in January, your customer A, was declared bankrupt in January, it is not an adjusting event. So those are the technical questions that the examiner will pick you up from. So you need to be sure. And if the examiner did not expressly state to say whether it happened in December or in January, then you now sit on the fence. You give those two positions to the examiner. That's your response. Because he did not tell me. Then I tell the examiner to say, if it were to happen in December, it becomes an adjusting event, then tell them the accounting treatment. If it were to be in January, but before financial statements are authorized for issue, you tell them it's a non-adjusting event. Okay, so the fact that there's a bankruptcy of a customer does not automatically mean that it's an adjusting event. You need to check when did it happen. Okay, when did it happen? So another example could be error, discovery of error or fraud. If you discover an error that already existed as at the balance sheet date in January, it's an adjusting event. If you discover fraud that already existed at the balance sheet date, it's an adjusting event. If the fraud happens in January, it's a non-adjusting event. It has to have existed. That's why I said provides further evidence of conditions that existed at the balance sheet date. When you go to a non-adjusting event, they are indicative of conditions that arose after the year end. That means they did not exist at the balance sheet date. They happened after the year end. For example, you dispose some of your subsidiary. Remember that question we saw under IFRS5 when it says on July 10. You remember? That's the classical example of a non-adjusting event. They arose at the end of the reporting period. Okay, you dispose major assets, you purchase major assets. Okay, so those are non-adjusting events. And according to IAS10, a non-adjusting event will only require a disclosure as a way of notes in the financial statement. And when you are making that disclosure, you are doing two things. You talk about the nature of the event and the estimate of the financial effect of that event. And that's it. That's it. That's the whole of IAS10 that I've tried to explain. This same thing I explained now, I can use 1 hour to also explain. But we are not done yet. We are not done yet, okay? I'm going to show you 1 or 2 questions so you can read up. You can read up. But let me tell you, let me bring you up to speed. Let me go more technical. Now the examiner can ask you, or they can frame a scenario. There are 2 major problems around IAS10. Okay, there are 2 major problems, and this is what I expect in SBR exam. Maybe at ICAN level, they can still be asking you direct question. When it comes to SBR in ACCA, you need to think of these 2 problems around IAS10. Number 1, window dressing. Okay, window dressing. You know, we've been talking about it, and I told you right from the first class that I'll be referring to that first class throughout this lecture. Okay, that's why that first class, go and watch that video again. Okay, it's very important. Window dressing. A lot of entity can use IAS10 to window dress their account. How do you do it? Shortly before the year end. Shortly before the year end, I already see that I'm not performing. I can devise means to make it look as if I am performing. What will I do? I have so many things at my fingertips that I can use. For example, I can do what we call channel stuffing. What's the meaning of channel stuffing? I'll be sending invoices to my customers when they have not placed an order. I'll be sending invoices to them We are operating accurate basis of accounting. I can recognize revenue, even though I will not comply with the provisions of IFRS15, revenue from contract with customer, but I'll just raise invoices. I'll be sending orders to them, okay, so that my revenue will go up. And when my revenue goes up, what happens to my profit for that year? It also goes up shortly before the year end. After the year end, I reverse those transactions because they did not occur in the first place. But my profit for that last year is already boosted. Okay, so that's a problem with IAS10. If it is not applied correctly, it can lead to window dressing. And remember, I told you, window dressing is both unethical and it is illegal. Okay, window dressing is both unethical and it is illegal. Creative accounting is legal, but it's unethical. When you create when you do creative accounting, what are you trying to do? You are trying to capitalize on the loopholes of accounting standards. For example, you can decide to change your accounting policy because you want to achieve a particular result. That's creative accounting. Okay, and that's why we have another standard around accounting policy. Maybe next 2 weeks I'm going to take you IAS8. All right, and we to take a look about what's it called? Accounting policy, changes in accounting estimate and error. Number 2 problem of IAS10 is which one is adjusting, which one is non-adjusting. It's always a problem in practice. I don't even know whether it's an adjusting event or non-adjusting event. So it's always a problem. So if you look at it, both events occur after the year end. So it's usually a problem. That's why anytime I take IAS10, I try to go as so low as possible so that my candidate or my students can really understand the concept around IAS10. That was why I was trying to emphasize certain things. Okay, so that's it. One more thing that we need to learn: dividend. So let me tell you about dividend. Okay, let me tell you about dividend. But before I tell you about dividend, something struck me now. When it comes to a non-adjusting event, we said it only requires a disclosure as a way of note to the financial statement. However, if a non-adjusting event, listen, if a non-adjusting event will impact on the going concern of an entity, remember going concern, the ability of a company to exist into a foreseeable future. And I pick you up to speed if you remember that the examiner can ask you to assess the going concern of an entity. So what do you tell the examiner? You take a look at financial concern, take a look at operational concern, then take a look at legal or regulatory concern. If you can remember, okay, you have done it. You see the linkage now. Einstein is now saying if a non-adjusting event will impact on the going concern of an entity, it becomes an adjusting event. So you're going to treat it as an adjusting event. Okay, so that's what struck me now. Okay, that I needed to tell you. So the last one here is what's it called? Dividend. Okay, anytime you see question on dividend around IAS10, dividend was proposed before the year end, but was paid after the year end. The question is, do I have a liability as at the year end? The answer is no. Okay, according to IAS10, if dividend is proposed before the year end, that means around November, you already proposed dividend or you declare and you now pay or declare after the year end, okay, there is no liability as at the year end because dividend are accounted for on a cash basis. Dividend are accounted for on a cash basis. When it comes to IAS10, you see question on dividend, forget the way the examiner is tossing you up and down. The answer is always that it is what's it called? It's a non-adjusting event, okay? Because they are accounted for on a cash base. So you don't need to go back to last year's account and recognize a liability, okay? So that's it. So you have this size 1. You can take a look at this, okay? Because of time, it's already 10. It's already 10. Okay, so let me take a look at one question. I'll just take a look at one question. Normally, at this level, I don't even treat any question around IAS10. I'll just explain and move on. But let me take a look at this question. Please go and read other ones. There's usually a lead time between the end of the entity's accounting year, when the financial statements are approved and signed up by the directors. In between this period, there are 2 types of events: whatever. Required. Identify and explain this event and state how they are treated in the financial statement. This is a very straightforward question. Okay, I'm just using this for you to come up to speed. This is SBR. So don't expect the examiner to start asking you identify and explain. If you really want to see questions that the examiner is going to ask you, then think about this example. Advise whether the director is correct. Okay, so we're going to look at this question. Okay, it's very straightforward actually, but I needed to show you something around this this other question, so that's why I'm picking it. Okay, so this is quite straightforward. Identify, adjust and non-adjusting. Explain this event. Then you explain them. This is indicative of condition that existed at the balance sheet date, and the other one arose and all of that. Then state how they are treated. I've told you everything. Now let's look at this. He said company A is indebted to company B to the tune of $50,000. The financial year end of company B is 30th June. So this is very key. Okay, this is key for me. So I pick it out. On 30th July, company B received a letter from liquidator advising that company A had gone into insolvency. The letter revealed that company A ceased operations a month ago. Did you see? A month ago. That means this guy has gone into liquidation as at the year end, because I received this letter on 30th July. My accounting year is 30th June. Okay, it ceased operation a month ago. If it ceased operation in July, it is a non-adjusting event. You need to take notes. Okay, you need to take note. And company B is only likely to receive a liquidation dividend of 20K for every naira or every dollar owed by the company A. It is normal practice of company B's board to approve audited financial statement 3 months. So it is IAS10, because it happens between the end of the reporting period but before financial statement authorized for issue. It now says explain how the above transaction will be treated. I just told you it's an adjusting event. Prepare journal entry. So what do? I can only take 20K, from this. So I can convert it back. I say 20 over 100 multiplied by 50. Okay, so that will give me, is that 40? Is that 10? Yeah, to give me 10, right? Or is it 40? Okay, let me see. Let me see. Yeah. It's going to give me 40, right? So that 40 is what I'm writing off as bad debt. So I just debit bad debt and credit receivables. Okay, now let me look at the last part of that question. Let's see. It says state what would have been the treatment in the financial statement, assuming it was fire that destroyed company's beef factory. Now listen, fire destroyed company's beef factory on 30th July. Fire did not exist at the balance sheet date. The value of that building, you remember, when you prepare statement of financial position, you say statement of financial position as at, did you see the point? As at 31st December. In January 1, the next day, fire got that factory or that asset. It will not affect that figure, except it will impact on going concern. You need to understand that. As at that date, the value of that asset remain the same. So if it was fire that got the factory or the asset of the building or whatever 1 month after, it is a non-adjusting event. You won't go back and correct that figure because fire did not occur at the year end. Okay, so that's why I said state what would have been the treatment. Okay, so that's what you need to understand. That's what you need to understand. And that's the end of IAS10. That's the end. So pick it up and understand all those stuff. So you have another question here that you can also take a look at. So that's the summary. Can you see? Summary of what I was explaining. I even drew it for you. Can you see? It gives new evidence of condition that is at balance sheet date. Can you see? Then you adjust the financial statement. Here, you only disclose nature of the event and all of that. But if it will impact on going concern, you will come and adjust. Can you see? That's everything I just explained. Okay, so that's it. That's it. And that's the end of IAS10. Any question for me? I wanted to use 15 minutes actually, but I used 20 minutes because I sure wanted to understand. Any question? I'm giving you 60 seconds to ask questions. Okay. A question for me, right? All right. So since there is no question for me, I think we can continue. Okay. So let's see whether I'm not too sure. We have a few minutes. Let's see whether we can deal with IAS21. Otherwise, we complete it in the next class. Okay. Now, IAS21 deals with the effect of changes in foreign exchange rate. Okay. If you wrote FR, financial reporting in ACCA, you should have been exposed to this. But if you wrote financial reporting in ICANN, it's not even your syllabus. Okay. So I want to assume everybody here is, getting to know IAS21 for the first time, except you've written corporate reporting in ICANN. That's when you must have been exposed to this. But I'm pretty sure you tell me I've forgotten. Okay, so it's very simple actually. So it's just the principle. Okay, now IAS21 deals with three things. Okay, the effect of changes in foreign exchange rate. Just three things. Okay, number one deals with the definition of functional and representation currencies. It also deals with accounting for individual transaction in a foreign currency. Then it also deals with translating the financial statement of a foreign operation. That's your foreign subsidiary, your group accounting. So I'm going to take you the first two now. So maybe at some point after we have started group accounting, we will now look at the third one, which is translating the financial statement of a foreign operation under group accounting. So it doesn't really make sense to start taking you down number 3 now when we have not started group accounting. Is that okay? So we still apply the same as 21 when we are dealing with translating the financial statement of a foreign operation. So the first thing is what is functional currency and what is presentation currency. So I'm going to define it for you. I'm going to explain. I'll tell you what you should expect from the examiner. A functional currency is a currency of a primary economic environment in which an entity is operating. That's it. Functional currency is a currency of the country, of the primary economic environment in which an entity operates. Okay? Now listen to me. In fact, I should have started like this. Okay? Now, whenever an entity engages in transaction in a currency other than its own national currency, IAS21 will apply. So let me say that again. Whenever an entity deals in transaction in a currency other than its own national currency, let me even call it functional currency, IAS21 will apply. What does that mean? If a company operates in Nigeria, for example, the functional currency is Naira. Even though some countries operate in Nigeria and our functional currency is not Naira, okay? It could be dollars, it depends. So I'm still coming there. But let's say the company operates in Nigeria, so naturally the Naira is the national currency. So you deal in Naira, you pay salaries in Naira, you buy in Naira, you sell in Naira, and all of that. The moment you engage in another currency other than the Naira, IAS21 will apply. For example, you order for goods from the US and you were invoiced in dollars. US company will never invoice you in Naira. It's not possible because that's not their currency. So they invoice you in dollars and you're going to pay them in dollars. Okay? So automatically you have to apply IAS21. Okay? That's how it's supposed to have started. So that you know. Then you can also buy, you buy in foreign currency or you sell in foreign currency. For example, you want to sell to a German company. You can quote, you may not be able to quote for them in Naira. Okay, even if you quote in Naira, they have to convert to their own Germany, is it euro or something? They pay in euro, you have to convert to Naira. Okay, so those are the issues. So once you deal with the currency other than your own currency, then obviously you apply IAS21. So functional currency is a currency of the primary economy environment in which an entity operates. Then presentation currency is a currency in which financial statements are presented. Okay, so the currency you use to present your financial statement, that's what we call presentation currency. Okay, now listen up. Now let me now pick you up on something. Now it is possible that a company or an entity is unable to determine its functional currency. Okay, most likely sometimes it's difficult to determine your functional currency. For example, you are dealing with dollars, you deal with Naira, you deal with euros, so you are battling with which one is actually your functional currency. IAS21 now states, in determining your functional currency or in determining the functional currency of an entity, you can look at primary factors. Okay, you can look at primary factors. Okay, now number one, you can take a look at the currency that mainly influences sales price for goods and services. Okay, so that would suggest that is your functional currency, the currency that mainly influences sales price for goods and services. Okay, number two, the currency of the country whose competitive forces and regulation mainly determine the sales price for goods and services. What's competitive forces? That's what's it called? Law of demand and supply. Okay, and regulation. For example, CBN. Okay, in Nigeria. Okay, so the currency of the country whose competitive forces and regulation mainly determine the sales price of goods and services. Then the last one, the currency that mainly influences labor, material, and other costs of providing goods and services. So the currency that mainly influences labor, material, and other costs of providing goods and services. So when you check these three primary factors, for example, let's say in number one, you got dollars. Number two, you got pound sterling. Then you don't still know your functional currency. But let's say number one, the currency that mainly influences sales price of goods is dollars. The currency that the country whose competitive forces and regulation mainly determine the sales price of goods and services is also dollars. Then the currency that mainly influences labor, material, and other costs of providing goods and services is also automatically, that's my functional currency. But once I have dollar in one, I have pound sterling in the other one, that means that primary factor is not sufficient. I will now go to secondary factor. So that's why you are seeing here, if the primary factors are inconclusive, then the following secondary factors will have to be considered. Two of them, the currency in which funds from financing activities are generated. The currency in which funds from financing activities are generated, and the currency in which receipts from operating activities are retained. The currency in which receipts from operating activities are retained. That's it. So that's it. So the currency in which funds from financial activities are generated, and the currency in which funds from in which receipts from operating activities are retained. So that secondary factor tell you whether your functional currency is pounds or dollars. So let's look at the question to demonstrate that. Let's look at the question to demonstrate that. Child is an entity located in a country whose currency is the dollar. So the fact that I'm in the United States or in a country where they spend dollar does not mean my functional currency is dollars. So we need to find out. Now let me look at the requirement. It said, what is the functional currency of Chai? Okay, is it Chai for chief? Anyone? At least you understand what I'm saying. Now, he said 70% of Chai sales are denominated in dollars. Can you see? 70% of Chai sales, primary factor, the currency that mainly influences sales price for goods and services. 30% are denominated in pound sterling. I cannot conclude with primary factor. You now say, Chai does not convert receipt from customer to other currency. Now, Chai buys most of its inventory and pays large proportion operating costs in sterling. Can you see the currency? Okay, that mainly influences or determine what's it called, labor, cost of production, cost of providing goods and services. Can you see that? So I cannot still conclude. I will now go to the secondary factor. Okay, I'll go to the secondary factor. So what's my secondary factor? The currency in which funds, okay, funds from what's it called, financing activities are generated. The currency in which receipts from operating activities are retained. So now say child has 2 bank loans. Can you see? Both of these loans are denominated in dollars automatically. This is my secondary factor. They have bank loan. You finance it in dollars now, because once you have loans in dollars, you also finance it in dollars. So automatically, the functional currency of child is dollars. It's as simple as that. Okay, successfully, we have looked at first part of IAS21. We have a few minutes to go. Let's now look at any question from. There's no question. Oh, really? Wow. Okay. That's fine. If you don't have questions, that's fine. Now, so let's now look at accounting for individual transactions denominated in foreign currency. Okay. So after we look at this, and that's the end. The other part is when we get to group accounting. Okay, IAS21 is, always very simple actually. But what I think candidates has problem is whether when you are converting, whether to divide or to multiply. That's where candidates have problems. So I'm going to explain that. But you see, what we just did, the functional and the presentation currency, the examiner gives you scenario questions and start asking you, to determine the functional currency. So you just apply that principle, okay? So that's why we look at that question. So they may not really bother you around that. Then if they are picking up on for SBR, they are picking you up on IAS21, they would have done, most likely they do the calculation, tells you how it has been accounted for. So you need to check whether they have complied with IAS21. So let's find out, when you have individual transaction denominated in foreign currency, what do you do? When an entity enters into a transaction in a currency other than its functional currency, my functional currency is Naira, for example, and I enter into a transaction in the US dollar, that transaction must be translated to functional currency before it is recorded. A US company has issued invoice to me, okay, or has paid me in dollars. I must translate it to Naira before I record it. So on initial record, okay, initially, I have to record that transaction or translate it using the spot exchange rate at the date of the transaction, okay? The date of the transaction, not even the date of payment, the date of transaction. For example, I place an order, for some certain instruments or whatever, or equipment. So at the date of the transaction, the worth of that goods in dollars, I must translate to my functional currency before it is recorded. So what exchange rate will I use? I will use the spot exchange rate, okay? So sometimes you can use the average rate over a period of time, provided the exchange rate has not fluctuated significantly. But I can tell you for free that where you use average rate is probably, apart from when you're doing group accounting, you use average rate for your profit or loss account. But normally for individual transaction, use average rate on interest on loan, okay? Interest on loan, because interest is paid over time. So it's ideal to use average rates, all right? So what you learn here is that you use spot exchange rate on the date the transaction occur. At the cash settlement, be with me here. Cash settlement. That means the date cash is settled, I must retranslate. Initially, I have translated. Is that okay? I have translated the date it occurred. That's the first time. Then when I'm now paying, That's a cash settlement. IAS21 says that amount must be retranslated to my functional currency. So when I retranslate, I will now have what we call exchange difference, because it's possible that those currency would have appreciated or depreciated against themselves. For example, Naira and dollar. Obviously, Naira would have depreciated, okay? All right, and a dollar would have appreciated against the Naira. So now have what we call exchange difference. How do I know the exchange difference? For example, let's say I'm buying, okay? I wanted to buy, that means I'm paying. So when I translate at the first instance, I have a particular figure in Naira. I'm supposed to pay 50K, 50,000 Naira. You know, I will use a particular exchange rate. Don't worry, I'm going to use real figures for you. I'm just trying to explain. Okay, at the date of settlement, when I'm now paying, I will retranslate using the spot exchange rate as at that date. Okay, so it would have changed really, right? Okay, so I'll use that spot exchange. So let's say when I now retranslate, and I have, let's say, 60K, 60,000. You know, initially I have 50 at the date of transaction. When I'm paying, that means I'm paying higher. 50 minus 60, that's 10. That 10,000 is exchange loss, because I was supposed to pay 50K, but I'm paying 60K. That's exchange loss. That's the exchange difference. I'll take it straight to profit or loss account as exchange loss. That's what they call it, the effect of changes in foreign exchange rates. Do you see the issue? You know, my problem or my issue around IAS21 is this. If it was at the date of that cash settlement that I'm actually placing that order and I'm also paying, I would have known that there was an exchange loss actually. But because the date of the transaction is different from the date I'm paying, that's why I'm seeing that there's a loss. It could be loss, it could be gain. Okay, so that's what I'm saying. So I need to record that performance or that loss or gain in my performance statement. That's what the standard is saying. The movement in exchange rates. Okay, so that's what you have on the cash settlements. Okay, so let me use, time is gone. Okay, so let me use this illustration. On 7th May 2006, an entity with a functional currency of dollars sold goods to a German entity for 48,000 euros. Okay, on this date, the rate of exchange is this. So now you know your principle. Listen to me. If you don't know the principle, you can't solve these questions. It's as simple as that. Accounting for individual transaction in foreign currency. So when I see this question, I already know that the standard tells me that whenever an entity enters into a transaction in a currency other than its functional currency, it must translate it to its functional currency before it is recorded using the spot exchange rate. It's as simple as that. So if you look at this, what is my exchange rate? Dollars. $1 to what's it called? 3.2 euros. Now, how will I know? So that means I needed to convert that 48,000 euros to my functional currency, which is the dollar. So how will I know whether I'm multiplying or I'm dividing? Okay, the answers are there, but let me explain to you, okay, so that you understand. I know some of you know it already. In fact, that's what you do in your office. So in fact, some of you are just laughing. Wait, I'm just wasting your time. Let's move from this page. But you know, like I said, I'm assuming zero knowledge. So now, how do I know whether I'm dividing or I am multiplying? So let me teach you that as far as I can. I hope you will understand. Okay. Now, when you look at the way they have quoted this exchange rate, you could see $1 to 3.2 euros. What does that mean? It simply means that dollar is stronger than euro. Okay. $1, just $1 will give me, it's equivalent to 3.2. Can you see? 3.2 euros. That means dollar is strong. All right. Just like you say $1 to 500 naira. Is that okay? Nigerian naira. So $1 equivalent to $500. 500 naira. Okay. So that means dollar is strong. That's the meaning. In fact, they can write it the other way around. They can say 3.2 euros to $1. It doesn't matter. This is not edging. You're not doing edging here. under your advanced financial management. Okay, so it doesn't matter that when you have direct quotes and indirect quotes, so ignore that. This is SBR, all right? Now, so that's to tell me my functional currency. Don't forget dollars is my functional currency, and this transaction was quoted in the weaker currency. Can you see that? The transaction was quoted in the weaker currency, and I want to translate to my stronger currency. I can never multiply. I will divide. Okay, I will divide. If you multiply, that means you are telling me that euro is stronger. Okay, but dollar is actually stronger, and it was quoted in the weaker currency. So for me to get a stronger currency, I have to divide. So that's why you see that 48,000 euros was divided so that I can get $15,000. Okay, then you debit receivables, then you credit revenue. They're going to pay. Okay, they now said on 28th July 2006. You see, if you know what that means, as simple, they will quote a lot of exchange rates. You needed to the date of the transaction and when the cash is settled. Just go and pick the exchange rate. So they give you the date. So now said on July 2006, the customer paid the outstanding balance. Okay, he paid everything. Can you see? I will retranslate again. So it gives me the date. That's the spot exchange rate. So I use this spot exchange rate. I will retranslate. So I divide this 48 again with this 3.7. Okay, 17. So I have 15,142. What does that mean? I am expecting $15,000 as at the date of the transaction. But when the payment was made, I got this. Is it a loss or gain? My class, is it a loss or gain? Gain! Can you see? I credit my receivables to knock off the debit. Then I record this difference. Exchange gain in my P&L. It's as simple as that. It's as simple as that. That's it. That is it though. The only one more thing that we need to learn is treatment at the year end. Okay? In this case, the whole amount was paid. So let's assume that the whole amount was not paid. That means there is an outstanding balance as at the year end. How do we treat it? Can I borrow about 10 minutes of your time so that we deal with this, so that we don't come to the next time, except when we get to what they call foreign subsidiary. 10 minutes, right? 10 minutes. Yeah. Let me just explain. So let's take that. I told you earlier that we might extend the class by maximum of 10 minutes so that we go and sleep because we are going to work tomorrow. So that we just close IAS21. Okay, let me see your consent. Okay, thank you very much. Thank you. All right, brilliant. So I believe we understood what I've just said, right? All this we understood, right? Okay, brilliant. Okay, so let me see, I saw a comment. Okay, thank you, ma. So just 10 minutes. It may not even get us there. This 10:30, right? 10:40, we are done. Now, we may not even get there. It depends on how you're able to quickly grab what I'm saying. Now, listen. So I am at the year end. Okay, the same illustration. Okay, so let me go back here. The same illustration, I would have recorded this, okay, initially at the date of the transaction. But if you look at here, they said the customer paid the outstanding balance. I paid everything. So let's assume I did not pay everything. I made payment for parts of this transaction. So that means when I'm preparing my account at the year end, there's a balance. So how do I record it? I will now ask myself 2 questions. 1, is it a monetary item or is it a non-monetary item? Now listen, I am at the year end, okay? I am at the year end. So the outstandings are there. It could also be me. I might also be the one paying. But in this particular question, I am expecting money. That is why. Okay, somebody is telling me that it's interesting because I do this every day at work without understanding the standard. Yeah, I said it. Now, you are actually doing our work. Yeah, so it will be so much interesting to you. Yeah, brilliant. Thank you. So, but we now know the standard now, so it will be better. Okay, so we'll be doing like this at work. Okay, fine. So now at the year end, I will now ask, is it monetary item or a non-monetary item? Okay. Now, monetary item, there are 4 of them. You see, that's how you have to read. You already know. Okay. So just ask yourself, is it cash? Is it payables? Is it receivables or loan? 4. That's monetary item. So once you have that transaction within that 4 category, cash, receivables, payables, or loan, then it is a monetary item. So if it's a monetary item, at year end, I have to retranslate using the spot exchange rate. That means you are using the closing exchange rate at year end. That's it. So like the example we did earlier, you know it's receivable. So that balance that is remaining, that I've not received, I have to retranslate using the closing exchange rate. But if it's a non-monetary item, okay, I have 3 of them. Non-current assets, for example, your PPE, inventory, and investment. I know. So if I'm dealing with PPE, I'm dealing with inventory, or I'm dealing with investment, it is a non-monetary item class. You will not retranslate. You will leave it like that. Okay? You will leave that balance like that at the end. Do not retranslate a non-monetary item. However, one more thing you need to learn, and that is the last thing. One more thing. If it is a PPE and is carried at fair value, you will retranslate using the spot exchange rate at the date the fair value is determined. And that is the end of IAS21. But I will use a question to demonstrate that. So let me say that again. Now, if it is a monetary item, cash, payables, receivables, or loan, you will retranslate using the closing exchange rate, right? If it is a non-monetary item, your non-current assets, inventory, or investment, you will not retranslate. However, it is a PPE that is carried under fair value model, okay? Maybe a land or building carried under fair value, you will retranslate using the spot exchange rate on the date that fair value was determined. So that's what you have here. Okay, so I don't need to look at these notes. I will just produce everything for you. Okay, it's as simple as that. If an item is carried at fair value, can you see that? The fair value should be retranslated on the date it was determined. That's it. So you also have exchange difference. You take it to P or L. Now let's look at the question we are dealing with earlier. Can you see? You remember we got to this place, that 15, can you remember the same illustration? We now said by the reporting date, 31st July 2020, the invoice has not been settled. And this is a monetary item. Why? Because it is receivables. So on this date, this is the exchange rate. I will have to retranslate. So when I retranslate, I have a loss because the euro has appreciated against the dollar. So the loss, I take it straight into my P or L. Is that okay? Now, let me tell you. Okay, now okay, I think I have about 6 minutes. Okay, now let me look at non-monetary item. Let's take a look. Olympic, which has a functional representation currency of dollars, account for land using cost model. Did you see that? Cost model. So when I see that, I will not retranslate, okay? Because normally you don't retranslate non-monetary item. Now said on 1st July 2015, Olympic purchased a plot of land for 1.2 million dinars, but my functional currency is dollars, okay? And they quoted it. That means I bought in a weaker currency. If I want to translate to my stronger currency, I divide. So this is the date of the transaction. I have to translate, okay? So it now said the land is initially recognized at cost. Can you see? So I divide it by 4. How do I get this 4? I pick it up on the date of the transaction. And at the year end, I will not retranslate. So they just put this exchange rate to confuse you. So that's why if you know what you are doing, you are fine. Did you see the issue now? You are fine. You just put it there. So you will use it. You look at it. It said land is a non-monetary item, so it is not retranslated in accordance with that. So no depreciation is charged. So this means that 300,000 that you got here, that's what it remains as at the year end. I have 5 minutes left. Okay. Now, pilot, because we are going to work tomorrow, right? Now, pilot, which are the functional currency. So the same question, can you see? The same question. It now said at 30th June 2026, the fair value of the land was 1.5. Okay. So I will first retranslate, I get this 300. That's what we did earlier. But because I am carrying it under fair value model, I will have to retranslate using the fair value at the date it was determined, using the exchange rate at the date the fair value was determined. So land is a non-monetary item, so its cost is not translated. However, in accordance with the evaluation model of IAS 16, fair value has been determined. So this is valuation of indigenous, and so must be translated into the functional currency. So when did we get it? They said at 30th June. Most likely it will always be at the year end that determine the fair value. So you now use this 3. Can you see? So you use that 3. You now say that original, what's it called? We have determined the fair value in dinars. Can you see? Let's see. Yeah, in dinars. So you bring it here, divide by 3, you have 500. Remember that the initial translation was 300. Can you remember? Okay. So because it's fair value, you now revalue to 500. Can you see? You revalue to 500. So that 200 difference, you take it to OCI. If you remember, under your OCI, exchange difference arising as a result of IAS21. This is where it is coming from. Remember, under IAS1. So this is where it is coming from. So you now take it to OCI, okay? And that is the end of IAS21. So you see some other questions there. So we're going to pick it. Just apply that principle. All you need to know is your functional currency, presentation currency. Remember your primary factors and your secondary factors. After that, remember your what's it called, accounting for individual transaction in a foreign exchange, individual transaction in a foreign currency. Okay, IAS21 requires that when an entity enters into a transaction other than the functional currency, it must translate it before it is recorded using the spot exchange rate. You can also use the average rate, provided it has not, fluctuated, over time. But I told you that when you see interest on loan, apply average rates. Okay. Then on cash settlement, you will also use spot exchange rate. You have to retranslate using the spot exchange rate, which can give you exchange difference, gain or loss. Whether gain or loss, you take it straight to profit or loss account. When it comes to year-end balance, you are going to determine whether it's a monetary item or non-monetary item. My monetary item talks about cash, receivables, payables, or loan. When it is a monetary item, I must retranslate using the closing exchange rate. If it is a non-monetary item, which can be non-current asset, inventory, or investment, I don't retranslate. However, I can only retranslate if PPE is carried under fair value model. Okay, I will use the spot exchange or the exchange rate at the date the fair value was determined. And that is the end. Thank you very much for your time. Thank you for the extra 10 minutes. At least we're able, to cover. So you have answers to, most of these things. So I'm going to see you next time by God's grace, and everything, is the summary of IAS21 is already in that diagram. Okay. Any concern? 1 minute. 1 minute more. 1 minute more. Thank you. So I'm so glad we were able to cover the target for the week. Yeah, I'm so glad. Okay. So there's no question from me. Okay, thank you. See ya next week. Okay. Thank you, Madam Tina. Thank you so much. So, but if you have question anytime, I'm here for you. I'm sure you have gained a lot of things. Yeah. So I'll see you next time. Good night.